Hello. So in this channel we have been making a lot of videos about individual stocks. Yet I wanted to create a new series that I'm gonna be naming Stock Battles, in which I'm gonna be talking about two direct competitors and analyzing their financials. And to begin with, we are going to start with AMD and Intel in this video. And you may want to stay with me here because we're gonna be examining all sorts of various graphs in an attempt to decide which of the two is a better value for our money, really. Now that doesn't mean that you shouldn't buy both of those or neither of those. I mean, it's always your decision. We're just going to take a look at some of the key metrics to decide whether one or the other is actually better potentially. And we start with the price of the stock. And we're examining the price of the two stocks over here. You'll see AMD and Intel together. And the actual price of the stock in terms of an absolute value doesn't really matter. I mean, AMD could be 1,000 or an Intel could be $5 and doesn't play any role. What matters is market capitalization if you want to examine the rates in the markets for these two competitors. However, it's generally speaking, the price and market cap is not something that I pay too much attention when deciding which company to add to my portfolio. I would pay attention to outstanding shares being decreased or decreased because I do want to know whether I'm diluted or not. Yet we're going to be examining some of the key metrics here as I mentioned. So let's start by taking a look at the comparison, and we're going to start by comparing the price to book ratio and the free cash flow per share for each of the two companies. And what is this graph over here? This graph basically combines the price to book ratio on the x-axis with the free cash flow per share on the y-axis. And free cash flow per share is basically sort of like a PE ratio, but it uses a free cash flow metric instead of the earnings metric, just because free cash flow is at the end a little bit more important. It has some extra expenses that are accounted for, and you kind of want to know how a company fares along in terms of its free cash flow. So, first things first, the price to book for AMD is more than 20 over here, as you can see. We don't really care about the very exact values here. We just want to see a quick comparison. So, AMD more than 20 in terms of price to book. Intel less than 2 or so. It's about 2. So, what does that mean? So, price to book ratio, basically you can think about it like this. If I have $1 that I want to invest in a company, how many assets do I get back from my dollar, for my dollar? And a ratio of 2, as is with Intel here, would give me about $2 for every $1 I invest. So the price is $2, the book is $1, and so price to book would be 2 over here. Now for AMD, with a price to book of 20, let's say 22, this means what? That for every $22 I invest, I will get $1 back. Price 22, book assets $1. So this basically means that for my money, I'm getting much less assets from AMD than I'm getting from Intel. This is what it means. And so when I decide to invest $1, I'm actually getting a tangible return in terms of assets, which is much higher with Intel than what it is with AMD. So at this level, price to book ratio, Intel will be winning. Now, what about free cash flow per share, which is very important, because you want to know for every share that you own, every piece of the company that you own, how much free cash flow are you getting back from the company's operations? And now with AMD, you will see that you are in this level about here, over here, which is a little bit less than 1. And with Intel over here, it's a little bit more than 5. And so you will see that you're getting more free cash flow per share over here with Intel. And that's very important, because you're getting more money for your shares, for the shares that you're holding. And so Intel also wins this battle. It has more free cash flow per share. Now, to continue with our next chart over here, we will examine the price to earnings when accounted for growth, the PEG ratio, and the current ratio for the two companies. And I wanted to include something that has growth as well, so that we can examine potential growth of these two companies. And obviously, these are projections. I mean, growth can be a little bit subjective or very subjective, really, because we don't really know what's going to happen in the future. We just have projections based on what analysts think, and we can also project based on historical data. Now, the price to earnings growth ratio is good to be less than 1, ideally, and so the higher it is, the worse it is for a company in terms of growth potentially. So over here, AMD is actually lower, and it is a little bit more than 1, but close to that. And Intel is much, much higher, so it's more than 6. So in this case, AMD definitely wins in terms of growth. It seems to be growing much more than Intel when you factor growth inside the P ratio, basically. And so if we are taking a look at PEG and we're using this or PEG to make investment decisions, then we would pick AMD here, and AMD would be the winner. What about the current ratio? The current ratio is just a ratio between the current assets of the company and the current liabilities of the company. It's just a division, current assets divided by current liabilities. And that tells us how many more assets we have in terms of a multiple when you compare them to our liabilities. And these are the current assets, and current liabilities, the ones that are about the next 12 months, the short term, as we call them. And so over here, you want to see a high value, because a higher value means that we have more assets than liabilities. And over here, AMD wins, has a 2.5, a little bit more current ratio, and Intel has a little bit less than 2 for a current ratio. So we're kind of in between right here. I mean, both companies have their merits so far. So what I want to do next is examine 2 key things: the outstanding shares of the company and how they have been affected over the years, and the revenue growth of the company, as well as the income growth of the company. So this will give me an idea of how much the company is growing over the years, and also I will see if the company is diluting investors, which is important. So for Intel over here, we go to shares outstanding, and we can see a graph over here that seems to be dropping in value. And so there was a little bit of an increase here, but generally speaking, over the years, Intel has been buying back shares, and so that's good for investors because their current shares get more value. So that's a positive thing. Now let's take a look at the income statement, and that will help us understand a little bit more about the growth of the company. So let me actually take it to 2017. I think it's more than enough. So you will see here that the year-over-year growth in revenue is stalling a little bit. It's almost the same. It's almost 0. So the company doesn't seem to be enjoying a lot of growth, and that's a little bit concerning with Intel. So it does make a lot of money, has awesome free cash flow, but it's not growing that much. And you will see it also in the net income over here. It's about the same, basically, year over year. However, much different than 2017. But after that year, it's basically the same thing. Now, that's not necessarily bad, but it's something to account for. So let's take a look at AMD now for the same things. Let me go to overview. And we're taking a look at the outstanding shares over here. And now we're seeing a little bit of a different story. And AMD seems to be diluting investors quite a lot. Now, frankly, these were probably some splits over here, although these are not too many stocks for a split. So no, this wasn't a split. So yeah, no, these are probably just some steep increases because of printing stock, basically. So the company is actually diluting shareholders a lot over here, and this is something that I never like to see. So company is financing itself by creating more shares. So yeah, that's a negative thing. And let's take a look at the income statement of AMD. Now, obviously, AMD has this as an important asset for it, and this is why the PEG ratio was better. They're growing much more, and so you will see here that they have a 45% growth, a 71% growth, and same for gross profit over here. And I'm pretty sure you're gonna see that on net income as well. Yes, company's net income keeps increasing. So the nice thing about AMD is that it looks more promising in terms of growth over the years. That's the difference. Let's take a little bit of a closer look at total debt to equity. which is very, very small for AMD, and also compare it with Intel's solvency. So Intel has a little bit more debt over here, but still it's not that much. So I wouldn't be too cautious about this. These are normal levels for debt. Frankly, AMD could even actually potentially use a little bit more debt, to tell you the truth, because debt is important for growing if you're doing it well. So what do I think about these two companies? We examined a lot of things, and all these things gave us told us a story about these two companies. And if I were to put that into words, this is what I would say. Intel is a company that's making a lot of free cash flow, more than AMD, yet it has been stalled a little bit in terms of growth. And AMD makes less free cash flow, but it still makes quite some good cash flow, yet it seems to be growing more than Intel. So the other thing, Intel seems much less overvalued. So actually Intel seems a little bit undervalued. And this is why we examine the free cash flow per share. And you saw a massive difference there. We're getting more money for our buck. And the same with assets. We're getting more assets price to book for buying a single share or multiple shares. And so if I were to pick between one of those two companies, this is how I would think. I would want to get Intel for sort of like holding kind of like a bank, because I'm getting money out of it, a lot of money, but limited growth. Yet if I wanted to make a play that potentially would give me money later, I could potentially add AMD. The problem with AMD is diluting shareholders a lot, and it's kind of expensive right now in terms of its stock price. And we saw that using the different metrics that we used. Seems a little bit overvalued right now. So at the very end, if I were to buy one of the two, I personally would buy Intel right now. Yet I still think that AMD is a good company and worth adding, but at a cheaper price if possible. That's what I would say. And hope you enjoyed the video, you liked this analysis. Let me know if you would like me to examine a specific set of stocks and companies, and I would do that for the next one. And so thank you for watching, and I'll see you in the next video. Bye bye.